In today's rapidly evolving business environment, corporate finance stands as a critical discipline that guides companies in making strategic decisions, managing risk, and optimizing resource allocation to maximize shareholder value. At its core, corporate finance involves determining how firms raise capital, invest in projects, and structure their operations to drive sustainable growth. This field is not just about numbers and spreadsheets. It is a strategic tool that shapes the future of organizations by influencing their ability to compete, innovate, and thrive in a competitive marketplace. One of the fundamental decisions in corporate finance is determining the optimal capital structure. Companies must carefully weigh the benefits and drawbacks of various financing sources, primarily debt and equity. Debt financing offers the advantage of tax-deductible interest payments and can amplify returns on investment when used prudently. However, it also increases financial leverage and the risk of insolvency, especially during economic downturns. Equity financing, while reducing the pressure of fixed obligations, can dilute ownership and control among existing shareholders. Striking the right balance between debt and equity is a delicate task, one that requires a deep understanding of market conditions, the cost of capital, and the firm's long-term strategic goals. The decision on capital structure impacts not only the company's risk profile, but also its ability to seize growth opportunities and weather financial challenges. Another cornerstone of corporate finance is capital budgeting, the process of evaluating and selecting investment projects that will drive future growth. Companies invest in a wide range of projects, from launching new product lines and expanding production capacity to entering new markets and adopting innovative technologies. To determine whether a project is worthwhile, firms employ various analytical tools such as net present value, NPV, internal rate of return, IRR, and payback period analysis. NPV, which discounts future cash flows to their present value, is particularly valuable because it accounts for the time value of money. A project with a positive NPV indicates that the expected returns exceed the cost of capital, thereby creating value for shareholders. Similarly, the IRR provides insight into the efficiency of an investment by identifying the rate at which a project breaks, even in terms of NPV. By rigorously analyzing potential investments, companies can ensure that they deploy capital in projects that yield the highest returns relative to their risks. Working capital management is yet another vital aspect of corporate finance. Efficient management of current assets and liabilities ensures that a company has sufficient liquidity to meet its short-term obligations and continue operations without disruption. This involves managing cash flows, inventories, receivables, and payables in a way that minimizes costs and maximizes operational efficiency. A well-managed working capital cycle not only supports day-to-day operations, but also enhances a firm's creditworthiness and bargaining power with suppliers and customers. Companies must constantly assess their liquidity positions and make adjustments to avoid scenarios where operational disruptions or unexpected expenses could jeopardize their financial stability. Risk management occupies a central place in corporate finance as companies face a wide array of uncertainties ranging from market volatility and interest rate fluctuations to geopolitical events and regulatory changes. Effective risk management strategies involve identifying potential risks, quantifying their impact, and implementing measures to mitigate them. This can include the use of hedging instruments such as derivatives to protect against adverse price movements in commodities, currencies, or interest rates. For instance, a company that operates internationally may use forward contracts or options to hedge against foreign exchange risk, thereby stabilizing its cash flows and protecting profit margins. By proactively managing risk, companies can reduce the likelihood of financial distress and position themselves to take advantage of market opportunities even in uncertain environments. Mergers and acquisitions, M&A, represent another dynamic facet of corporate finance that can dramatically alter the competitive landscape. Through M&A, companies can achieve rapid expansion, gain access to new technologies, or enter untapped markets. The process of merging with or acquiring another company involves complex valuation techniques, due diligence, and negotiations. Synergies, such as cost savings, increased market share, or enhanced operational efficiencies, are often cited as the primary rationale for M&A activity. However, the integration of two distinct corporate cultures and operational systems can pose significant challenges. Successful M&A transactions require not only financial acumen, but also a clear strategic vision and meticulous execution to ensure that the anticipated benefits are realized. Corporate governance is inextricably linked to the practice of corporate finance. Strong governance structures ensure that a company's management acts in the best interests of its shareholders and other stakeholders. This includes establishing clear policies, accountability mechanisms, and ethical standards that guide decision-making processes. A well-governed company is more likely to attract investment as investors have greater confidence in its leadership and strategic direction. Corporate governance issues, such as agency problems where the interests of managers diverge from those of shareholders, can lead to suboptimal decisions and inefficient capital allocation. By aligning the incentives of management with the long-term objectives of the firm, companies can foster a culture of transparency and accountability that ultimately drives financial performance and sustainability. In recent years, environmental, social, and governance (ESG) factors have emerged as integral components of corporate finance. Investors and stakeholders increasingly demand that companies not only deliver financial returns, but also operate in a socially responsible and environmentally sustainable manner. Integrating ESG considerations into corporate strategy can enhance a company's reputation, reduce regulatory risks, and unlock new opportunities in emerging markets. For example, companies that invest in renewable energy, sustainable supply chains, or community development initiatives may benefit from improved brand loyalty and access to capital from socially conscious investors. By adopting ESG principles, businesses can achieve a more holistic approach to value creation that transcends traditional financial metrics. The strategic planning process in corporate finance also involves long-term forecasting and scenario analysis. Companies must anticipate changes in market trends, technological advancements, and regulatory environments to remain competitive. Financial models and forecasting techniques are employed to predict future revenue streams, estimate capital needs, and assess the potential impact of various economic scenarios. This forward-looking approach enables companies to develop contingency plans, allocate resources effectively, and mitigate the risks associated with uncertainty. Strategic planning in corporate finance is not a one-time exercise. It is an ongoing process that requires continuous monitoring, reassessment, and adaptation to evolving conditions. Financial performance measurement and management are essential for ensuring that corporate finance strategies are effectively translated into operational success. Key performance indicators, KPIs, such as return on investment, ROI, earnings before interest, taxes, depreciation, and amortization, EBITDA, and economic value added, EVA, provide insights into how well a company is utilizing its resources to generate profits. These metrics allow management to benchmark performance against industry peers, identify areas for improvement, and adjust strategies as necessary. By linking financial performance metrics to strategic objectives, companies can foster a culture of continuous improvement that drives operational efficiency and long-term profitability. In the realm of financing strategies, companies must also navigate the complexities of raising capital in both public and private markets. Public offerings, such as initial public offerings, IPOs, or secondary equity offerings, provide access to a broad pool of investors, but require significant regulatory compliance and transparency. Private placements, on the other hand, may offer more flexibility and speed, but often come with trade-offs in terms of investor reach and market visibility. The choice between public and private financing is influenced by factors such as the company's size, growth stage, and strategic objectives. Regardless of the method, the ultimate goal is to secure the funds necessary to support expansion, innovation, and competitive positioning while maintaining an optimal cost of capital. Debt financing remains a popular choice for many companies due to its potential to enhance returns through leverage. However, managing debt requires careful attention to interest rates, maturity profiles, and refinancing risks. Companies must develop strategies to manage their debt portfolios, which may include refinancing high-cost debt, locking in favorable interest rates, or diversifying funding sources. Credit ratings, which reflect a company's creditworthiness, play a crucial role in determining borrowing costs and access to capital. Maintaining a strong credit profile is therefore essential, as it enables companies to secure financing on favorable terms and invest in growth initiatives without compromising financial stability. Corporate finance also extends to the realm of innovation and technological transformation. As digital technologies disrupt traditional business models, companies must invest in new technologies, research and development, R&D, and digital infrastructure to remain competitive. Financial decision makers are increasingly tasked with evaluating the return on investment in technology projects, which may include software development, cybersecurity, data analytics, and automation. These investments are critical for driving operational efficiencies, enhancing customer experiences, and enabling agile responses to market shifts. Balancing the costs of technological innovation with the potential for long-term benefits is a complex challenge that requires both analytical rigor and strategic foresight. Globalization has added another layer of complexity to corporate finance as companies increasingly operate in multiple countries and navigate diverse regulatory, cultural, and economic environments. Cross-border transactions, foreign investments, and international trade introduce additional risks such as currency fluctuations, political instability, and differing legal frameworks. To manage these challenges, companies often employ hedging strategies, establish multinational financing structures, and work closely with financial institutions that have a global presence. Understanding the interplay between domestic and international financial markets is critical for companies seeking to expand their operations and capture value on a global scale. In addition to traditional sources of finance, emerging trends in financial technology, fintech, are reshaping how companies access capital and manage financial transactions. Innovations such as blockchain, digital currencies, and peer-to-peer lending platforms are creating new opportunities for raising funds and streamlining financial processes. These technologies can reduce transaction costs, improve transparency, and enhance the efficiency of capital markets. For example, blockchain technology offers the potential to revolutionize the way companies record and verify financial transactions, thereby reducing the risk of fraud and improving auditability. As fintech continues to evolve, corporate finance professionals must stay abreast of these developments and consider how they can be integrated into existing financial strategies to drive innovation and competitive advantage. The dynamic nature of corporate finance means that companies must be agile in adapting to changes in economic conditions, regulatory requirements, and competitive pressures. Flexibility in financial planning and execution is essential for responding to unexpected events such as economic downturns, market disruptions, or shifts in consumer behavior. By maintaining a diversified portfolio of financing sources, robust risk management practices, and a forward-thinking strategic vision, companies can navigate uncertainty while seizing growth opportunities. This adaptability not only protects the company's financial health, but also positions it to capitalize on emerging trends and new market opportunities as they arise. Ultimately, the practice of corporate finance is about more than just managing money. It is about making informed, strategic decisions that drive value creation and support long-term success. Whether it is through optimizing capital structure, rigorously evaluating investment opportunities, managing risk, or embracing technological innovation, corporate finance provides the tools and frameworks necessary to transform ambitious visions into reality. Companies that excel in corporate finance are better equipped to pursue strategic initiatives, maintain competitive advantages, and deliver sustainable returns to shareholders. The journey through corporate finance is a continuous one, marked by the need for constant learning, adaptation, and proactive decision-making. Leaders in this field must cultivate a deep understanding of both the theoretical underpinnings and the practical applications of financial principles. They must also be prepared to challenge conventional wisdom, explore innovative financing solutions, and collaborate across functions to drive holistic value creation. In doing so, corporate finance not only supports immediate operational needs, but also lays the foundation for a resilient and prosperous future. By embracing a comprehensive approach to corporate finance, companies create an environment where strategic investments are made with confidence, risks are managed with precision, and growth is pursued with an unwavering focus. In a world where market conditions can change overnight, the principles of sound corporate finance serve as a stabilizing force, a roadmap that guides companies through both prosperous times and periods of uncertainty. As businesses continue to evolve and adapt to new challenges, the role of corporate finance will remain as essential as ever in shaping a future defined by innovation, resilience, and long-term success.